Revenue decline at BlackBerry apparently not delighting investors. Let's get more from John Zechner, chairman and founder of Zechner Associates. John, thanks very much indeed. You and I have been tracking BlackBerry for years now. What's your view on the stock? I mean, they've carved out quite a franchise with this QNX software. It's used in autos and elsewhere.
No, you're right, Andy. I mean, QNX, probably actually the last major acquisition that Jim Balsillie did back in the day. And that's really almost become the heart of the company right now. Having said that, that was a bit of a disappointment. I think the year over year growth was around 10%. And I think the market expectations had been about 15%. But they're really only down to the two core businesses right now, that and secure communications, which is effectively the old Silence and what they have left of their cybersecurity operations, where they really didn't make much of an imprint there. It's been a disappointment, and I think the year-over-year revenue was down about 10%. So you look at it on that basis, the company's hardly growing. It's got the two divisions left. One is actually shrinking, the other is sort of the core of it and growing and doing fine, but that doesn't justify the valuation, trading about 25 times EBIT, which is you pay that for an extremely high growth company in a strong field and market dominance, and I don't think they're showing it there. I mean, you wind the clock back, like I said, Andy, there's been a lot of ups and downs over the years. I think John Chen, I never got, he properly, I think, was appreciated what he actually did when he came in and took over the company in 2013, and effectively their core business was headed to zero. How do you do that when your core business is headed to zero? You had to replace it in a hurry, and I think he did a good job sort of putting it in a position just to keep it alive this long, but it's nothing you're paying for the growth for. There's nothing, particularly proprietary about any of their software. Then certainly they did not make much of a dent in cybersecurity, despite the fact that, the old BlackBerry Messenger was one of the best sort of security platforms back in its day, but they never really sort of parlayed that into better growth.
Let's talk about Nike. They just cannot fix their Chinese business, it seems.
Chinese business was difficult. The sales channels are going into sort of direct sales as opposed to the broad-based sales through channels. The Converse brand is not doing that well. The numbers actually beat the expectations, but just the guidance going forward is sloppy. And like I say, China sales are a big part of that. And I mean, it's more the same we're seeing, Andy. Cost-conscious consumers out there are paying less for the branded names. And they're sort of driven to brands, but still, they're not going to pay the big premiums for it. You see margins under pressure as well. I mean, you go back to what Lululemon and the restructuring they're doing, and how miserable that stock has been for the sort of past year and a half, and that's just more of the same. And I think Nike is going through that as well. They just they've got the brand, they've got the name, but they're not getting the premium, and they're not getting the proper distribution. And China sales had been a big part of it in the past, and that's clearly is diminishing.
Apparently, the China. Excuse me. You touched on this, John. Apparently, China is different. It's a so-called monobrand economy for this kind of product. And companies typically sell through their own stores. Now, I know Nike does that, but they're having trouble selling through other retailers there.
Yeah, they are. And I mean, the guys who have probably beaten that metric better than anybody in China is Apple, because it's the same thing. You've got a lot of competition from domestic brands that are effectively no-name brands. You're trying to sell a premium product at a premium price, and yet their sales have held up pretty well in there. So, kudos to them. They sort of beaten that that metric a little bit.
Oracle involved in taking over TikTok. It seems weird to me that a company, this was a database software company and enterprise software company, now involved in social media.
They got the feelers out everywhere, Andy. I mean, I'm sort of just writing some year-end comments, and I've seen a line that I've seen lately that I like. If NVIDIA is the AI coal mine, is Oracle the canary in that coal mine? And it really has been, because there's a few things. I mean, it popped in September massively. It got north of $300 on the big, because they were trying to position themselves as the AI cloud company going forward. They had the big order flow. They had the massive increase of 300 billion over the next six years effectively. But people then started to question a little bit of how are you getting the finance on it, their debt spreads are going higher, and and the definition is RPOs, remaining performance obligations. It's not even really revenue; it's something that could turn into revenue, and that's a lot of what they were reporting, and that's why all the skepticism is rising up about this. Okay, how real is this? So that is a bit of a worry, and then sort of the convoluted financing and debt financing you're seeing in the sector is worrying a lot of people, and Oracle really seems to be at the front end of this. Yeah, they dominate database software, which they have for years. So it sort of makes sense. If data is the most important part of sort of the AI expansion, if you can make yourself an AI cloud player, you're going to do it off an Oracle database, an Oracle-based data center, and you can sort of see why that makes sense. But the stock is so far ahead of itself that they're doing all this finance via debt, and people are just getting uncomfortable. I mean, you can stay in technology, and there's a lot of safer places to go where you're not paying big multiples. Some stocks have been under pressure. I look at the software companies, the Adobes and Salesforces of the world, even some of the big hyperscalers, Amazon, Alphabet, Meta. I don't see as a big risk in there. I think they'll integrate AI better than most of the rest. They got the platforms on the public clouds where they can do it. The more speculative players are the ones that I think can get into trouble. Those are the ones, you look at a CoreWeave. And even what Oracle did, how quickly it's come off. I think it's 40% down from its September peak. So, that's the danger in there. People just get too excited about a concept. But there's that time when you've actually got to deliver on the numbers and the revenue and everything else. And if that doesn't happen, boy, oh boy, there's a lot of air underneath those stocks.
Yeah, it's interesting. I should have said that Oracle is apparently part of an investor group that's going to control a joint venture that will run TikTok's U.S. business. Yeah, John,
which is that's a great platform. I mean, it sort of makes sense, and they wanted to get it out of the Chinese hands, and clearly, it's there's a lot of users of it right now, so you do want to sort of, it's an advantage to whoever can get a hold of it. So Oracle has been sort of leading that charge for a while, so it is a positive that they've got it, but they've got a lot of oars in the water right now, that's for sure, and they're not all yielding returns.
Thank you very much indeed, John. John Zechner, chairman and founder of Zechner Associates.